Companies keep choosing Dallas Fort Worth to be their home. Jobs follow companies, and people follow the jobs. What people aren't talking about is absorption, right? If you look at the Q2 data of this year, we absorbed around 10,800 units. That's the strongest quarter of the absorptions we've seen since Q3 of 2021, right?
We have liked Dallas for a long time. The difference for us is the ability to enter at a price point with an attractive yield with the same fundamentals still exist.
The U.S. multifamily market has been a major area of focus for Greybrook thus far this year. It is one of the largest, deepest, and most diversified real estate investment markets in the world. Now, within the U.S., there are hundreds of metropolitan markets, each shaped by its own economic drivers, demographic trends, and supply dynamics. This breadth of opportunity, I think, is ideal for investors looking to build long-term exposure to income-producing real estate. It allows investors to essentially be highly selective, focusing on the markets where long-term fundamentals are the strongest. For Greybrook, that's exactly how we've been approaching this market. Our strategy is centered on acquiring stabilized Class B apartment communities in high-growth Sunbelt and select Midwest market regions. This is where we believe long-term population growth are strong, employment trends are strong, and housing demand continues to create attractive long-term investment opportunities. Today, we're going to take a closer look at one of those markets, specifically the Dallas-Fort Worth market. Dallas-Fort Worth has become one of the fastest growing metropolitan areas in all of the United States. It's one of the country's most diversified economies. You've got 24 of the Fortune 500 headquarters in Dallas-Fort Worth, thinking AT&T, Southwest Airlines, just to name a few. Now, to coincide with all that growth, you have Dallas-Fort Worth that's experienced a significant wave of new apartment construction over the last several years. That's contributed to that broader narrative around oversupply across the Sunbelt. This makes it especially important, I think, to understand where Dallas sits in the current supply cycle today. How is demand absorbing those new units? What are the conditions specifically for the stabilized Class B multifamily assets? On today's episode, I hope to answer some of those questions. We'll unpack the demand and supply dynamics shaping the Dallas market. We'll discuss what's changing on the ground, and we'll explore why Greybrook continues to view Dallas-Fort Worth as one of the most attractive markets for the long-term investment in stabilized Class B multifamily. Joining me today is Karl Brady, president of Greybrook's U.S. multifamily platform, and Grant Raymond, senior director of Texas Multifamily Advisory Group at Cushman and Wakefield, one of Dallas-Fort Worth's leading multifamily investment brokers. Karl, Grant, welcome to Boardroom Brief.
Alex, good to be here again.
Thanks, Grant. Welcome. I know it's your first time, hopefully the first of several as we continue to operate in Dallas-Fort Worth. All right, gents, I want to start it off. Karl, I'll sort of throw the first question at you. I kind of spoke about, the diversity in all these different metropolitan markets in the U.S. When it comes to Dallas specifically, what about that market would you say is unique or makes it attractive for Greybrook to target it as an acquisition market?
Yeah, listen, in your intro, you covered kind of quite a bit some of the fundamentals that we really look at, like how we look and assess all of our acquisitions and how we assess markets in the US is really split into a couple of different lenses. We're looking at first what the long-term fundamentals are. We're looking at where we're at in the cycle, and also we're looking at, the economics of the actual deal, right? So we're playing, we're looking at three different components, but ultimately we're looking at the real estate and the market. And with the market, we're looking at the cycle. So of course, over the last kind of few years, we've seen multiple markets go through different oversupply dynamics within the markets, which we can talk a little bit further on later. But what we're looking for is strong population growth, strong wage growth, family formations. So we're looking at a lot of the macroeconomic factors. And then we're also looking at what we're getting on an entry point. So that's where we kind of falls under the real estate component, is where we're looking at what point in the cycle are we entering, what price are we paying for, either an in-place income, and what are the future opportunities? What are we buying on a price per square foot? What are we buying on a rent per square foot? What is the cost to replace that asset? In other words, like, what is our downside protection? And then what is the value we are able to create to kind of capture some upside. So that's kind of what we're looking at in all of the markets. It is all backed by fundamentals, and we're always watching fundamentals in all of these markets. And then it's kind of asset specific in entry point, value creation, in place yields is kind of is how we analyze different deals. And Dallas is a market, of course, where we feel very strongly, along with some other Sunbelt and Midwest markets, where we feel very strongly about the fundamentals, but also at the point where we're now entering. That's kind of the big difference.
So, I mean, we're looking at a lot of these characteristics, and Grant, I'll ask you, Karl's described a few or several of the characteristics that we'd like to be present when we're acquiring these assets. You're sort of on the front line conducting a lot of these transactions. You've seen the trend. Does this stuff play out in reality? What do you think sort of contributed to a lot of the growth you've seen over the last decade?
Yeah, I mean, look, I think Karl described it, exactly what we're seeing happening here right now today. I mean, the simple version, companies keep choosing Dallas-Fort Worth to be their home. Jobs follow companies and people follow the jobs. You look back in 2010, there was about 1.2 million people here. Where today, that's 8.5 million people. So, we're the fourth largest metro in the nation. We're adding over 100,000 people over here the past year. And again, there's 24 Fortune 500 companies here in Dallas-Fort Worth that are making it its home. I think the big news today is finance, right? You look at Goldman Sachs, who is building, their largest campus outside of New York here. You had Wells Fargo, who built a $570 million campus in Irving. You got Bank of America, who's building next to our office here in Uptown. You got Morgan Stanley. Schwab moved its headquarters here to Dallas as well. So, I think, a lot of people maybe on this call, Scotiabank, right? So I think, the amount of job creation that's going on in DFW is creating a lot of household formation, right? I think a lot of people are talking about the big headline news about supply, but we'll dive into absorption a little bit later here into this call. But DFW market is humming along, right? We're moving people here. You're following fundamentals, and again, that's where capital wants to be active, right? DFW continues to be a tier one gateway market across the U.S. and where people want to be the most active in today.
Yeah, so I mean, you and Karl just touched on just sort of one of the themes I wanted to discuss during this episode, which is the oversupply side. So you have a lot of this construction build, Karl. You clearly have some of these headlines and trends talking about oversupply in certain Sunbelt markets. How do you reconcile that, Karl, with like our continued conviction in Dallas, despite sort of some of these data points we're seeing?
Yeah, listen, Grant gave good insight into what the fundamentals is. And I think it's important to acknowledge the reason why it's a big headline is because the oversupply story is real, right? Like the oversupply, Dallas and a lot of other Sunbelt metros, they build a large number of apartments. Developers, there was a lot of there's population growth, just like Grant said. You have a lot of companies moving into Dallas, Fort Worth specifically. Of course, rent growth was very strong and financing was cheap, right? So like from a capital stack perspective, you could underwrite long-term growth. You had the strong fundamentals and financing was relatively cheap. So what happened is a lot of supply did come online. So over a period of time, and the market was oversupplied. But that's where we kind of see an opportunity is like, it's not about, was the market oversupplied? It's whether it's oversupplied kind of going forward is where we're more kind of focused, which is, are we still seeing the strong fundamentals, which we are, everything that kind of Grant had alluded to on the last question there, but we're still seeing them fundamentals, but we're not seeing the future supply. There's still supply, currently in production, but post that supply coming online, we're seeing very strong absorption. And where we focus in is the ability of new supply. And that doesn't mean from a pure, regulatory, which we would be used to here in Canada. It's more from the economics of a deal. In Dallas, Fort Worth, or a lot of the major US metros, to be honest, we're very focused on replacement cost and also the rent you would need to achieve in order to bring new product online in today's environment. So although oversupply is real, we have seen it as an opportunity. What it has done is that caused a short-term decrease in, there's there's definitely concessions, decreases in rent, and increases in vacancy. But we still see the strong long-term fundamentals that exist, and we believe the ability to bring new supply online. If that happens, it will be very good for us. It would mean that rents have to go up quite a lot in
Sure.
order to close that gap to make it economically viable to bring on new supply. So as long as we see, continued population growth, continue wage growth, we feel, very strongly that we have a lot of tailwind, which is why we chose now as an entry point into this market.
Yeah, I think that is sort of one of the fundamentals of the thesis is the acquisition below replacement cost, right? So
Yep.
I think when you talk about that element and then you talk about the new supply, the underwriting looks obviously different for new stuff versus existing inventory and what you need to charge for rent. So I totally understand what you're saying. Grant, if I sort of narrow the timeline now down to, let's say, the last 2 or 3 years, right, and sort of the trend that's happened in Dallas, like what would you say, being on the front lines, that's happening that the headlines may not be capturing?
I think the headlines continue to talk about 2023 and 2024, but it's not as much looking at what's occurring today. Really, I mean, Dallas-Fort Worth is historically building 40 to 45,000 units a year. You'll see 20 to 25,000 of those units come online each respective year. Obviously, post-COVID, rates at zero, construction went crazy. I think that's not just for DFW, that's a lot of the Sunbelt metros. 2023, we delivered around 45,000 units and, or sorry, I said that's in 2024. 2025, we had around 35,000 units, where you're looking at this year around 21 to 22,000, units coming online, which is about a half a fall off from what we've seen at its peak. But what people aren't talking about is absorption, right?
Sure.
If you look at the Q2 data of this year, we absorbed around 10,800 units. That's the strongest quarter of absorption since we've seen, really since Q3 of 2021, right? So demand hasn't changed. Obviously, we've had a huge stock that we're working through, and as Karl was mentioning, look, it's put a lot of pressure on operations right now. We're seeing rents have continued to fall off for the last couple of years. Concessions are at all-time highs. Market vacancy and delinquency, right? But the truly of everybody's perspective is we've hit the bottom of the market, right? This is the next wave, especially as Greybrook's looking to invest today. It's the best time, right? We've bottomed. This is the best buying opportunities. There's replacement cost stories. There's great yield that people are chasing. And, I think a lot of that 23, 24 acquisitions was chasing basis, right? It was chasing replacement costs where, today people want to see a little bit better cash flow, cash yield. So the product that's coming to market, whether commodity or non-commodity, right? It's, people are chasing that extra yield play, and DFW is presenting some good yield finally, which has been a little bit of the struggle the last couple of years. But, demand hasn't changed. Supply has been, all-time highs in more historical years that we've been battling through. But again, we're in a pretty big wave that's coming here, and we're super optimistic of what's coming.
Yeah,
And
and just to add to that, Alex,
Go
just
ahead,
like because that's like when we talk about replacement cost and we talk about good point in entry, we're talking about, of course, price per square foot on construction, but we're also talking about where we're at from a yield perspective and what an entry cap rate looks like. Right now you're able to buy in these markets at cap rates that we haven't seen for the last 10 years. So we're buying where rents have pulled off, and we're underwriting the current market, which is lower rents, higher cap rates, higher financing costs. And then it's about looking at the fundamentals of where can we go from here. So we're buying an in-place income with really strong fundamentals going forward, right? So that's kind of, we definitely have seen the pull off, and that's why we feel like it's the perfect time.
And when we talk, we've spoken about the diversity in the metropolitans, and we've zoned in on DFW as an interesting one. There's also diversity in the type of asset that we could be going after, and we seem to be very focused on Class B as the sort of definition of an asset class that we really like as the sweet spot. Can you just give us, Karl, your definition of Class B and why we're specifically targeting that asset class in DFW?
Yeah, listen, when we talk about Class B, we're really talking about good quality, stabilized assets, communities in good markets. Typically, definitions can vary, but typically between 10 and 30 years old, operating in good locations. Rent is meaningfully discounted to what Class A new build. That's how we define. Some people may categorize Class A and Class B based on vintage, and I'm sure Grant and Cushman, Wake will have their own kind of definition. But for us, it's like, is there, the last 10 to 30 years, is there a big discount to Class A rents? That's how we would define that. Ultimately, because we're really looking for the ability to kind of obviously increase rents, but still be at a significant discount to new supply coming online. So that's how we classify it. Obviously, we also look at things that there's an opportunity for us to increase rents and bring that asset up closer to a Class A, but we're never intending, we'll never get a Class B in our definition to a Class A. It's about offering a product in a good area with good amenities and a good rent to income ratios and affordability metrics.
And Grant, like when we talk about the oversupply and we talk about, clearly I would imagine, and you guys can correct me if I'm wrong, but the new inventory coming in by default would be classified as Class A or close to it. Is there a direct correlation that you're seeing on the pressures of the Class A that has on the Class B? Like, does it all rise with the tide type of thing?
It does ride with the tide. I think, like there's been real pressure. There's, no way to kind of, beat around the bush on that. I would say it's been narrowed than the headlines are suggesting right now. Nearly all the new supply, in the luxury Class A that you're seeing in some of these, high supply submarkets right now, I'd say that's probably where the biggest concession push is right now. The metro formed about 47,000, new households last year, and most of them can't pay new build, luxury rents, right? So again, that flight to quality and, as people are chasing some newer construction properties, right, as they're kind of getting out there, they're somewhat concession hopping, right? There's just 6 to 8 to 12 week concessions in most cases, right?
Wow.
But I think you really look at the North Dallas corridor, right? That's the Planos, the Friscos, the Allens, McKinneys, and really getting to the Highway 380 corridor, where that includes Anna, Melissa, Prosper, Salina, that's over a third of the supply stock that's going in DFW right now, right? So that's where there's probably the biggest pressure on rents, and probably the highest concessions that we've seen ever, right? So I think in terms of again, the renter who is a little bit more focused on Class B, liking that lower density lifestyle, something a little bit more kind of like a household, right? Where, most of the product and what the municipalities are requiring you to do up in North Dallas, you got to build high density. It's 5-story, it's structured park. If you're wanting to live in a garden style community, you're going 10 to 15 minutes further up north, right? But maybe you're chasing that cheaper cost of living. Again, it's, I'd say it's been tough, right? The Class A to Class B, classes here in DFW have both felt pressure. A little bit more on the Class A side than it has Class B. But there's definitely some green shoots out there. There's supply, there's definitely some markets that are outperforming, others, right? And that's more being higher barrier to entry, right? And I think, as we talk more with, the Greybrook team about, where the best investment opportunities do lie and which submarkets we feel are going to bounce back quicker than others, I think that's very important as you're looking at, the pros and the cons and outweighing some of those risks of where, hey, there's more land, there's going to be continuous supply over there, right? But the Class B is going to continue to perform and there's a renter for it and will continue to be household formation around that asset class right now.
And within Dallas Fort Worth, like with, we've named it as one of these interesting metropolitans, but you've just named a bunch of different submarkets within that area, right? Do you find that it's sort of one brush paints the picture, or is each submarket unique in its own distinction on opportunity and what to look for?
Each submarket is very distinct, right? North Dallas is really booming because we've been talking about, Fortune 500 companies and headquarter relocations, right? Frisco is going to be one of the business centers of North Texas in the next 3 to 5 years, right? You've got, DFW and, what we call the urban core infill, right? This is where all your office was. Irving, another huge employment hub for DFW where the, highest density offices, right? But, Frisco's that next push and what that's doing for the Planos, the Frisco's, the Allens, right? And, your surrounding submarkets, you chase jobs, right? But, people also want to check some other boxes, right? That's where your strongest incomes are. That's where some of your best school districts are. That's where families are moving. That's where couples are moving. So the population growth up north and being, outside of Dallas is kind of where, capital wants to be active and they're chasing, great opportunities in markets that will have those long-term fundamentals and aren't going to shift as much as maybe some other weaker submarkets because they don't have the jobs, they don't have the schools, they don't have the incomes, right? So, you got to chase fundamentals more importantly.
And Carl, like, as I'm listening to Grant talk out loud, a lot of the things he's mentioning are kind of the characteristics you mentioned at the top of the episode. So do we do that sort of like kind of call it micro level magnifying glass analysis where we are looking at the very specific submarket and we want those characteristics to be present when we're acquiring?
Yeah, I think you can hear from Grant. It's a long list. When you look at the Dallas Fort Worth market, there is a enormous amount of submarkets kind of within that market. So once we've selected a market, we're drilling down, doing everything we do from a fundamental rent to income ratio, school zone, population growth at a submarket level. So we're doing the same due diligence and the same underwriting and macro fundamental analysis that we do at a state, city, and then we get down to into a submarket level, right? So that's kind of the same work that we're doing, and that's how we select kind of properties that fit within that mandate, along with not only the fundamentals. I just don't want to get away with this. You can have really strong fundamentals, but we're also tying that into the supply, the entry price point, the cost to buy, price per square foot. We're looking at a combination of all of them. We're not just looking at, this market is the most booming market, but it's also the most expensive market, and there's a lot of supply coming on, and that's where everybody is flocking to. So we're looking for a combination and a mix that really protects our downside. We're buying at a good cost basis with strong fundamentals. So that's kind of how we look at it.
And so I'll sort of end it off with one distinct question to each of you guys. Carl, if you're talking directly to an investor that's evaluating U.S. multifamily, what's one thing you'd sort of mention about Dallas, Fort Worth specifically that you think makes it a compelling opportunity? And Grant, for you, you're obviously a local to the market. You know that market inside out. What do you think if I'm an investor and I'm looking at that market as an outsider? What's one thing that you think investors may misunderstand about the market? Carl, I'll let you go first.
Yeah, for us, I think the story on Dallas has always been there, particularly over the last few years. We have liked Dallas for a long time. We've been looking at market for a long time, and the fundamentals are still there. The difference for us is the ability to enter at a price point or an attractive price point with an attractive yield with the same fundamentals still exist. So for us, it's now a better time than ever. Everything Grant has said, talking about kind of the macro indicators, has existed. This is not like a point in time where this is just starting to happen. It's been there for a long time. As Grant has said, population has grown enormously over the last kind of, 15, 16 years. But it's our entry point that's enabling us to really kind of double down on them fundamentals. So for us, what I would say is it's always important, from investors and from everybody to look at the combination between market fundamentals, entry point, and future growth potential. And that's where we see that convergence of them three things in this market right now.
That's three things. I said one thing, but I'll let it go, Carl. I'll let it go. Grant, to you, what's one thing you think people or investors misunderstand about the market as an outsider?
It's always the $1 million question. I think a lot of people treat Dallas or Fort Worth as just one number, right? When you really look at Dallas Fort Worth, it's a dozen markets, right? DFW covers 11 counties. This is a huge area that DFW covers. So alone sits in 11 different cities in DFW, right? So, each employment corridor has its own renter profile, its own supply picture, its own risk, right? So really diving into each submarket and that market knowledge, that understanding is super important, right? So rather than thinking of Dallas as just one city, you really need to kind of nitpick it and really figure out where the best opportunities lie, where the best investments are going to be, and where the most demand drivers are actually going to be lying. So, again, that's where I come in, and I spend a lot of time on these type of calls and with investors, talking through, where to invest, what are the pros and the cons, and look at the best buying opportunities here.
Yeah, I think for myself, when I look at this discussion and I think about Dallas Fort Worth and a lot of the characteristics we've spoken about, there's headlines and there's only so much information you can gauge from that. But just like as a layman and understanding the US and the trend for a lot of the interstate migration that people are experiencing, the layer beneath that, I think, Grant, you sort of really touched on it, is a lot of the employment that comes with it. Some of the brands that you mentioned, the JP Morgans and even Scotia, and some of the brands that are more familiar to us, them making that decision at an institutional level to say, hey, this is where we want to kind of plant our flag and push our base, is very telling, right? And I think as that population growth continues, and as we sort of continue to follow our fundamentals, Dallas Fort Worth, I think, as a market, will be very active and beyond sort of some of the early acquisitions that the multifamily fund is making. So Grant, Karl, thank you very much for joining me today. Really appreciate it. To our listeners, if you want to learn more about Greybrook or our fund, please visit us at greybrook.com or click the link below. Gentlemen, thank you very much.
Thanks
so much for having me.
Thanks.